Hi there, it's Michael Thorne from Remax Little Oak Realty in Langley, BC and bchomeconsultants.com. Just want to do a quick video for you today regarding the announcement that was made last week to the changes in lending regulations that are going to come to effect on July 9th, 2012. Over the last couple days, I've sat down with two different clients that raised the exact same issue with one of the changes. And the change that they were most concerned about was the change from a maximum amortization period of 30 years down to 25 years on insured mortgages. And they both raised the same concern. Their concern was that it was going to be more costly now to own a home. And I think it's quite the opposite. So I sat down with both of them and I went through an exercise, and at the end of it, they saw things quite differently. So I thought I would do the exact same exercise for you today in this video. So what we're going to do is we're going to compare the difference between a 30-year and a 25-year mortgage. We're going to use a purchase price of $500,000, a down payment of 5% at $25,000, which leaves us a mortgage amount of $475,000. And we're going to be using an interest rate of 3.5% for our calculations. Now, one of the interesting things that's likely to happen based on these changes that were announced last week is that we're going to see interest rates stay low for a longer period of time. So on a 30-year mortgage at $475,000, your monthly mortgage payment is $2,126.28. And on a 25-year amortization, your mortgage payment is going to be $2,371.54. So when you compare those two, there is an additional cost of $245.26 on a 25-year mortgage. And this was the concern that they had. They say, see, the mortgage, it costs more. It costs us $245 more every month to have the same home. But in every mortgage payment you make, there's two components. There's principal and there's interest. Now, the interest is like rent. It's money that you pay and it goes away and it never comes back. But the other portion is principal. This is like a savings account. You get to keep every dime that you pay down your principal when you go and sell your property down the road. So principal is money you keep. So if we look at the very first mortgage payment you're going to make between the two, they contain the exact same amount of interest, $1,375 worth of interest. They're exactly the same. But you can see under the 25-year, you're going to pay an additional $245.26 worth of principal. Now, you can see even from the very first month, you get to keep every single dime of that $245 extra you're going to be paying every month. Now, if we fast forward and take a look at the end of the 5th year, the 60th monthly payment that you're going to make, you're going to see that under a 30-year, you're going to end up paying $45 more a month in interest over a 25-year. And on a 25-year, you're going to be paying down an additional $294 worth of principal. So that original increase of $245 has now increased over time to $294. Plus you're keeping an extra $54 worth of interest. So at the end of 5 years, you will have saved $1,330 worth of interest, and you will have paid down your mortgage extra by about $16,000 over a 30-year term. So if you take your $245.26 extra you're paying every month, times it by your 5 years, you're going to be paying an extra $14,715. But when you consider that you're going to save $1,330, plus you will have paid down your mortgage an additional $16,000, that $14,715 has turned into $17,376. So you can see that every month that goes by, that extra $245 grows and grows and grows. But let's fast forward another 5 years and take a look at where you'll be at the end of 10 years. You will have saved $5,700 worth of interest over a 30-year amortization term, and you will have paid down your mortgage by an additional $35,131. Combining those two numbers leaves you $40,832 ahead of the exact same mortgage over a 30-year amortization period. And one other thing, not only will you be ahead by $40,000, but you'll be 15 years away from paying off your mortgage, whereas on a 30-year term, you'll still have 20 years left to pay off your mortgage. So you can see for a small investment every month of $245, it really changes into a huge savings over the long term, which makes owning a home under a 25-year term much more affordable. I hope this helps. If you have any questions, please leave them below in the comment section or find us online at www.bchomeconsultants.com. Thanks for watching, and we'll talk to you soon.